All right. Well, happy spring, everybody. My name is Tom Steinley. I'm the Managing Director of Business Development for Lear. I'm joined by Jim Warner, our Head of Research and Co-Portfolio Manager. This is the May 2026 Lear Market and Strategy Update. Jim, I was thinking about this over the weekend. I've been working with you on these webinars, moderating the webinars for 4.5 years, and the thing that I continue to hear most frequently from advisors and clients is how it helps them connect to their portfolios. Our research and insights are really helpful, but what people really seem to appreciate is how your comments can be tied directly to portfolio positioning. And as most people on the call know, we invest in secular themes that usually play out over multiple years, but often short-term changes in the market conditions require us to be very nimble and very tactical, which is where we excel. And these webinars on a monthly basis is the best way for us to communicate our thinking and process. So, as a reminder, this is entirely 100% for the folks on the call. For your benefit, please ask questions. Do it through the Q&A button at the bottom of the screen. And Jim, with that, let's just jump right in.
All right, perfect. Thank you, Tom. Thank you, everyone, for being here. I'm going to share my screen. Okay, so this month, we're going to dig into what I'll call the AI Moonshot. For those who've been paying attention, we've obviously had a huge rip in a lot of the AI names. And so we'll talk about that in some detail. We'll talk about the macro, and then, of course, how we're positioning portfolios to adjust for this ever-changing environment, as Tom just alluded to. So, let's see here. There we go. So let me start first with our returns. I usually leave this to the end, but might as well start here. And like Tom said, we are tactical, we are thematic, and we have conviction. And those are the three things I think make us different than a lot of other investors. Our I'm showing here our four products, four major products. I excluded strategic income for no good reason, but here we have the Lear Global Vigilance Moderate is up 11% for the year, 38.9% for over the last 1 year. This is, these are all net of fees. Our more aggressive products up 12.5% this year, 45% over the last year. Our ETF version, which is for smaller accounts, is up 9, and our conservative is even up 9 and a healthy 32%. This is the one that got us named Manager of the Decade. And as you can see, it's been around for over 10 years, as has the moderate. And as I always point out, it's this 9% number that I think is the key. Yes, we can have some really great years like we're having, but it's this that shows the consistency and the compounding of wealth for clients over time. As you can see, we're having a good run at it and beating the S&P, which is not, it doesn't always happen because we're running with some bonds as well in our moderate. So let's talk about a macro recap, kind of what the headlines are missing, our interpretation. We're going to go into detail on what I'll call the AI capital stack, and then positioning, what we're doing about it. And then I would love to get your questions. So there's a Q&A button at the bottom. Please type it in. It's anonymous. Feel free to ask any question. There are no dumb questions. So the backdrop, really, I think the thing that to keep in mind, because a lot of people ask me, well, why is the market ripping when the Strait of Hormuz is still closed? And well, obviously, this started with the sort of ceasefire, which seems to be kind of shaky. And while there's settlement is trying to be negotiated between the Trump administration and Iran, who knows where that goes. But what basically is, that while that dominates the headlines, if you look past that, the fundamentals are really unambiguously good. We'll talk about how strong corporate earnings are. We just finished up the Q1 earnings season. The CapEx cycle is extraordinary and providing major tailwinds for the economy. Policy has been another tailwind. And of course, geopolitics continues to be a wild card. We'll go through all the risks that we're watching very closely at the end of this, okay? So Let's start with earnings. The Q1 earnings season was really phenomenal. One of the better earnings seasons we've seen in a while. And I think it also happened at a point where expectations were pretty low. The 85% beat rate is north of the historical average of 73%. The size of the beat was 12.6%. That was higher than the typical long-term average, which is a 5% beat. Uh, 2026 EPS revisions for the S&P 500 were up 7%. And remember, that's how a lot of stocks move, is they move with earnings revisions. So as those expectations for future earnings improve beyond expectations, stocks and the market, generally move upward on that. And operating margins also came in very, very strong at 19.6%, which is important because remember, there are still tariffs out there. There are wage headwinds. There's, all sorts of other pressures now with input prices. So now, again, this is a historical snapshot, but what this would indicate to you at least is that corporate America is generally bullish, even in spite of where oil prices are today and the current situation with the Strait of Hormuz. Payrolls also beat, and importantly, construction and architectural related jobs those actually, there was actual net creation of jobs in those two sectors as well, which is great because that supports our industrial resurgence theme, which I'll talk more about later. But as you can see from the chart on the right, I really like to track this particular data point. It's the ADP weekly payrolls, and I look at it on a 4-week moving average just to kind of, smooth out the bumps because it can be a little volatile. But as you can see, there's a clear trajectory up given if you start with the weakness that we saw last summer in the payrolls, and you've seen a nice sort of move up. And remember, the ADP does not track government payrolls, which have generally been weak. And it doesn't track, obviously, farm, but it tracks, everything else, I think, fairly well. And so this actually is an encouraging sign that businesses are not only upbeat about their earnings, they're upbeat about hiring. So, but obviously the Hormuz is still closed. Oil is still elevated around $100 a barrel. But markets have been looking through this. And I think this is an important point. Now, we can't have this Hormuz Strait closed forever. I mean, that would obviously flow through and ultimately really impact economies and corporate earnings. But typically the way the market treats events like this, it could be like tsunami damage or hurricane damage, or, the market tends to view these incidents as temporary and very short run and not longer term. And when we do that, any negative impact that happens, in this case, oil prices, let's say you're an airline company, your quarterly earnings are going to be terrible, right, this quarter. But the market will look through it because if it's a short run temporary event, then it really hasn't impacted your core earnings power. And so as the market looks out 12 to 18 months, it's saying, well, you know what? This Hormuz issue will be resolved. Oil prices will decline sufficiently, and we'll just kind of look through this noise in the that we are experiencing right now. That is the current consensus. Now, it could be wrong. We could see an escalation. We could see the Strait of Hormuz not reopen in the near term. I think there's a term going around called nacho, which I think refers to basically never opening. That obviously would have a very uh, deleterious impact on a lot of businesses and economies. We're kind of more insulated in the United States, but take Japan, for example, that would be pretty problematic for them. But as we stand here today, that's how the market is rallying, is that we're looking through this issue as a very short run, extraordinary item. Now, what is powering the market right now is this massive AI tidal wave and this tidal wave of spending by the hyperscalers. As we went through, the assumption before earnings season was that there would be roughly $650 billion spent on building out AI data centers and the large language models. That increased during earnings. Most of the hyperscalers came out and increased their CapEx budgets, and we're now at roughly 850 to 900 billion dollars being spent this year alone. Next year, it could be the same amount. It could be even more. We don't know, but it's certainly not going to stop. And this is what essentially is driving a whole separate economy that has really nothing to do with the Strait of Hormuz. And this is what's really been ripping in the market in the last month. The other thing that I think people have overlooked is just how much fiscal stimulus is actually still in the pipeline. These, for example, are three bills that were signed into law under President Biden, and barely any of it has been spent. So you have like half a trillion from the infrastructure law, basically half a trillion from the Chips and Science Act, 400 billion from the Inflation Reduction Act. Then you factor in the tax-free spending and capex that was put in the big beautiful bill that just hit, and then add in another trillion or so dollars that were committed to reshoring plants by a lot of foreign companies and domestic companies. There is just so much going on that it's very hard to look past this flood of money that's hitting the economy right now. Last year we were basically just talking about it. This year you're actually seeing the shovels hit the dirt. And so to this point, we are seeing a pickup in construction. You're seeing a pickup in the spending on inputs, whether it's cement or steel or HVAC. In fact, we recently added Johnson Controls to the portfolio, where they make the big, huge HVACs that you use in a data center, that you use in a big building, you use in a manufacturing plant. Their backlog is through the roof. Trucking is now finally turning. We entered into that. We had added trucking exposure earlier this year on the hopes that all of this, would actually translate into, more construction. The particular trucking stock we own actually benefits a lot from construction, but we're seeing that turn, and that industry has been in a recession since 2022. So that's all improving. So there's a lot of exciting things that are going on in this market, going on in this economy. Here's another example of how manufacturing is now turning, and this has been again the thesis, one of our the thesis behind our industrial resurgence theme. You're seeing, take a look at this ISM manufacturing PMI chart. As you all know, below 50, kind of in this pink area, means manufacturing is not growing, but above 50 means it is growing, and you can see this pretty dramatic turn that happened around year end. And so we've seen three now prints above 50, and I don't see any reason why that isn't going to continue. So how do we, pardon me, interpret this? Well, I thought it would be interesting to kind of look at how we think about AI in general. And we call this the AI capital stack. So these are kind of the sub industries that benefit from this whole AI tidal wave of spending, and to a lesser extent from the other fiscal stimulus that's occurring. And I'll go through each one, but basically they fall into four categories, which is data center operators and hyperscalers, electrification and power, chips and silicon, and then an industry that you probably haven't thought of, specialty chemicals and industrial gases, which we are increasingly interested in and adding exposure to in portfolios. And these, you can see just the year-to-date performance by all of these sub sectors beat the S&P 500, and some very dramatically, like chips and silicon. So let's go through each one real quick. So layer one, the foundation, this is kind of the boring layer that nobody talks about, which is the specialty chemicals and gases. But this is literally the building blocks for making chips and wafers that go into the GPUs that then go into the data center. So this is the very bottom of the stack, or the beginning of the funnel, if you will, where the AI dollars have to go. And here we think it's a pretty overlooked area. In fact, over the last month, when all the AI names were ripping, this basket of names that I created was actually down 1%. And so we are actively adding to this sector and think it's very interesting. The backlogs are there. They have long-term contracts. And in some cases, you have oligopolies, so you have incredible pricing power. So this is a fascinating subsector that's benefiting from AI that I think a lot of folks are kind of overlooking. The second layer, which basically everybody knows, is the chips and silicon. So, this is, where, we own Micron, we own Qualcomm. These are the guys that are making the chips that go into the things that, allow AI to function. These have had a hell of a run. If you've been watching Micron, I mean, I don't know how much we're up on it, but it's probably 5 or 6x. And a lot of that is being driven right now, not just by volumes, but because DRAM memory spot prices have gone up, in this case, 585% over the last year. So it's just been a phenomenal name. I'm going to talk more about Micron in a minute, but we are, using this opportunity to be disciplined and to trim it. The name is getting, and some of these names are getting crowded, and so that obviously creates some risk for pullback. I mean, just look at what the name did yesterday. I had a big pullback, and then today it's right back at it. So we'll talk a little bit about how we think about trimming versus exiting when I get to that section. But this has been great. We still love it, but we're trimming our winners. Um, the third layer is the electrification and power. And we've had exposure to this for quite some time. We just added some additional exposure with Johnson Controls, but we've owned names like Vertiv in the past and Invent and folks like that that are make the cooling systems and the piping, if you will, that go in the data centers. And that had a very good this last month. It certainly benefited from this AI rip. Was up 8%. What's also happening, as you probably are aware, is that there are a number of regions or states or cities that are getting anxious over and political backlash with data centers plugging directly into the grid. And so there is a wave and kind of push for data centers to be able to create their own power. And if you've been watching like a GE Vernova or some of those folks, you've had this enormous surge in demand for turbines that you need in order to do that. And so, it's just you're seeing essentially this AI wave like just really spread out amongst a lot of industrial companies. So it's not just tech companies that are working. There's a lot of industrial companies that do historically very non-sexy things, like electrical equipment and whatnot. But they are seeing enormous growth in their backlog, and we continue to add to this area. And then the fourth layer are the spenders. So the data center operators and hyperscalers, these are your Googles and your Metas and your Amazons, but also your Irons and CoreWeaves of the world. Those folks that are actually building data center capacity. They're the ones buying the NVIDIA chips. They're the ones that are actually spending that 850 to 900 billion dollars. And while we have some exposure to it, I think there's certainly places where we still think there's a lot of upside. But in general, we rather own the people that are receiving the companies that are receiving the 850 to 900 billion as opposed to spending it. And so we're sort of on hold, I'd say, with this particular layer. And if you look at kind of how each layer has performed, the specialty chemicals really have not done much. It's up a little bit versus the S&P. It's outperformed by 6.2%. So we're adding it, but it's certainly not up like the chips that are up 79, 80% year to date. Electrification is up 31. We still like pockets of this. And then the data centers and hyperscalers have also done quite well, certainly relative to the S&P. So how are we positioning for this? Well, I think where we sit here today, a lot of the technical factors that we look at suggest that many names are overbought in the short run. The market is somewhat overbought as well. And when that happens, you need to be disciplined to trim. And you can still like it over the long term, but overbought can mean that sentiment is sort of one-sided, the trade's getting a little crowded, and there's greater risk to and you're more vulnerable to kind of a sharp correction. Now, That's where we trim when we still like the name long term. But we just maybe it's gotten out, a little bit ahead of itself, or maybe it's gotten to be a little bit too large in the portfolio. That's when we'll trim. Now, when we trim, we also have to, for particularly for taxable accounts, think about the tax consequences of that. And so all of that does factor into our thinking. But for now, being disciplined and trimming your winners is an important thing for making sure that you're being tactical and that you're removing risk, potential risk from the portfolios. Now, overvalued is something different. Overvalued is when the valuations get way out over their ski tips and the future earnings power doesn't support the multiple. And in these cases, we will sell and we will exit. We don't think a lot of these AI stack names are near that at this point. So we aren't really exiting those names. Although interestingly, in one portfolio, we did just exit Microsoft, which is still challenged as a software company. There's, a lot of question marks as to what is the terminal value would ascribe to a software company, given how incredible AI is at creating software. So, we are always looking to make sure that our thesis is still on point, and if we're overvalued, we will move on from names. Which brings me back to Micron. Micron has had this extraordinary rise over the last year. And if you step back and think about when we entered this name, our thought was that with all of this growth in GPUs, you had to have high bandwidth memory and you had to have a lot of it. And in fact, if we get into inferencing and we move out into physical AI, the edge, we're going to need even more of it. And we just saw this enormous amount of demand and not enough ability to supply it. And so we figured that not only would volumes be going up, but prices for DRAM would also go up, and they have significantly. Now, what's interesting though is if you look at the chart on the right, this is the forward PE of Micron. And basically, today, even in spite of this meteoric rise, it's still at only 13.8 times next 12 months. And if you actually look out to 2027, it's trading at like 7 times PE, which is extraordinarily low for a business experiencing this kind of earnings growth rate. Now, why is this? Well, historically, DRAM is incredibly cyclical. What happens is, historically speaking, DRAM goes into, laptops and PCs, and you'll go through like a PC cycle, and there'll be this big upgrade cycle, and the memory guys will go out and they'll spend a bunch of money to build a ton of extra capacity to supply the cycle, but it turns out just to be a cycle. And then all of a sudden, they have all this supply and they don't have enough demand, and the prices crash. And this is like habitual over the last, 30 years. You've seen these wicked swings in DRAM pricing because of this mismatch in demand and supply. One of our thesis was, okay, well, in addition to we think an explosion in earnings, we also think there could be a total re-rating of this stock. So what if I told you that this AI spending was going to continue for the next decade? What would you value this stock at? It wouldn't be 13.8 times, right? I mean, what if I told you that this thing could compound earnings over the next decade or even just 5 years at 30%? You wouldn't be putting a 13.8 times multiple on it. So I think there is a real potential that this thing could keep going and re-rate higher, maybe into maybe to 25 times earnings, maybe to 30 times earnings. It's a little difficult to say. But we think that there's still an opportunity for a re-rating, which is why we still really like it and why we're trimming it and we're not, exiting it. Which is essentially what this slide tells you is that essentially we're trimming the winners and we're applying a great deal of discipline to make sure that we don't just keep running with them. What are we adding to in the portfolio? I already mentioned electrification and power, that level 3 of the AI stack. We're adding to the specialty chemicals and industrial gases, the layer 1 of the AI stack. We are still adding to industrial reshoring beneficiaries, whether it's the inputs or the trucking or that sort of thing. We're still looking to add physical AI future winners. So think when we say physical AI, which is a theme of ours, or edge AI, think cell phones, think autonomous driving in cars, think robotics. The robotics and humanoid theme would be a theme all unto itself, and probably will be a year from now, because we are right on the cusp of starting to see an enormous flood of robots. It's going to be pretty crazy. But names that we own that will benefit from that are NVIDIA, Qualcomm, and Tesla will be huge winners. And then we think that at some point, and it hasn't happened yet, AI should unlock what we call the golden age of healthcare, where drug discovery should accelerate. It should become cheaper and easier, and we should be able to cure more diseases that have kind of eluded us, maybe cancer. We think that there is an enormous opportunity in the future for AI to benefit the healthcare sector, so we're spending a lot of time on that as well. For optionality, we still hold a decent chunk of cash in short-term treasuries, and that gives us a cushion. So if we do have a pullback, which is always inevitable, 5% pullbacks happen all the time for absolutely no reason. We have cushion and we have excess cash to take advantage of that. So we're not, at this point, like running away from this market and going risk off, but we are just being disciplined to, again, trim our winners. But there's still a lot of opportunity to add, honestly, names that have not run and been quite overlooked. But what are we looking for in terms of red flags? So what would make us more conservative and take some risk off? Obviously, the Hormuz situation and oil prices would be, sort of first and foremost. If it looks like there's just no hope, we may have to do some repositioning to take advantage to really understand where it's not just oil prices and input costs, but ultimately that could lead to demand destruction. So where would that happen? I think we're fairly well positioned to handle that situation, but I can imagine we will do some more tweaking if that were the case. Another big risk would be data center utilization starts to fall. Now, I don't see any situation I do not see that situation occurring anytime soon, but certainly that would be a worry. Now, if you think back to what happened during the dot-com bubble, Cisco was like the poster child of the dot-com bubble, had this huge run up because there was this massive buildup in fiber optic cabling and to string up the internet everywhere. And what ended up happening was that there was a massive overbuild, and so that created ultimately a big part of the dot-com blow up, and a lot of that fiber lay dark and unused for many many years. Now, the one big difference, and I think I pointed this out maybe a few months ago, is that there are no dark GPUs. There are no GPUs out there that are not being fully utilized. But if there were, evidence to suggest that we're starting to see some, let up in utilization, that would be a big warning sign, and we'd have to reposition. Credit markets, we talked a little bit a few months ago about private credit. We talked about how we didn't really see it being contagious and that sort of thing. And so far, the credit markets are hanging in there, but we watch the spreads on high yield bonds pretty closely. We watch a lot of the credit metrics, whether it's credit cards or auto loans or student loans, these sorts of things. We watch that closely. And while generally the credit is still basically normalizing from all the subsidies that occurred during COVID. There's an article out this morning about how student loan delinquencies are, back to essentially their previous record, and that to me is just more of a normalization. Now, if it goes a lot further than that, then we have a different conversation on our hands. But for now, credit seems to be hanging in there, particularly on the corporate front. Earnings revisions. If earnings revisions start to be going down, not up, that's obviously a big warning sign. So we'll watch that, but that's not happening just yet. And then, of course, concentration is always an issue. A lot of people who own the index or are invested with managers that are index huggers, which a lot are, they don't realize how much they of Nvidia they own. It's 8% of the S&P 500. We don't own anywhere close to that. But 8% is an enormous. In fact, we're not allowed under our own risk parameters to own a stock that has 8% exposure. So that's particularly, that is that's a concern really for other people, but concentration does matter, and so we pointed out. And then lastly, policy. Now, policy out of the Trump administration seems to be very pro-economy, pro-growth. But of course, we saw, the tariffs show up and really create an enormous kerfuffle in the markets. One that we ultimately took advantage of, but we'd have to be we have to really understand how economic or how political winds change and how they can impact industrial policy. And then, of course, we have the midterms coming up. And honestly, you know, if you look at sort of where the betting markets are, the House goes Democrat. It's right now pretty much a toss up in the Senate. If that were the case, then we'll have some sort of a stalemate. And I would imagine that much gets done in the next, the 2 years after that. So who knows what that actually means? It's usually good for the markets, but we'll just have to wait and see how this all goes and adjust accordingly. But normally, I don't see. Normally, it's the first kind of 2 years when a president wins, where you see sort of the most radical policies produced, and usually, because they might lose one house, you see something more tame in the next 2 years, or the last 2 years. We'll see how it goes this time around, but we can't ever take a day off, trying to predict what President Trump could offer out. So let me stop there and address some of the questions that you guys have.
Great. Awesome stuff, Jim. By the way, I like the new look, and I like the new layout of the slide deck. It's very easy to follow. I like the structure. Well done. Yep, a couple questions here. One of them is, you were talking about cash and the fact that that we still have a fair amount of cash on hand as dry powder. The question is, it looks like we have greatly reduced our cash position in the portfolio. Can you explain the thinking behind this? And the question may be obviously referring to the fact that a month or two ago we had close to 10-13% in cash.
Yeah. Well, I mean, let's just rewind the tape. So last year, a lot of the AI and electrification names really ripped, and they did really well. So what did we do? We trimmed going into this year, and we actually shifted into on the margin, we shifted into energy and defense. As the Iran conflict started brewing, and we actually saw that second carrier group go over to the Middle East, we started to get a little nervous and we started raising cash. And then as the market was falling, and it ultimately fell about 10% or so, we continued to trim winners and sell losers that for tax losses. And we didn't have very many, but we did that to raise cash. And we raised about in most portfolios, we got to about 20 to 25% cash. And when I say cash, I mean cash plus bill. Bill is the short-term, treasury ETF, and we use that as a proxy for cash because it effectively is. So we were very heavy on cash, maybe the heaviest we've ever been in our history. And then and we waited for essentially there to be maximum uncertainty. And then, because once you get to max uncertainty, the next step is a little less uncertainty. And of course, the ceasefire occurred. And so, while yes, you still had uncertainty about the Strait of Hormuz being closed and whatnot, that basically marked the bottom for the market and marked the beginning of us deploying that cash back into the market. And what did we principally deploy it into? It was largely these AI names that we had trimmed back at the beginning of the year. And that proved to be the right call because essentially you saw basically the AI trade rip, largely because it's less cyclical, has less to do with the overall economy than being that's driven by oil prices and that sort of thing. So that's basically been the pattern. That's why you're seeing in these accounts a lot less cash because, as I said, on probably 2 months ago, three, even maybe probably on the March call, I said the thing that was keeping me up at night wasn't the Iran conflict or anything like that. It was if the market started to rip. And as you can see, we had a very V-shaped recovery, and thankfully, we've been able to participate in that by getting that money back to work.
Great. Yeah, thanks. Um, this Trump visit to China is on a lot of people's mind. This question has to do with that. Is there a sense in the market that the U.S. is going to ask China to intercede in Iran? And if so, but if that does not happen, could the market pull back just on that news alone?
Well, I think they've already been talking. I mean, I think by the time you get to two leaders meeting, there's probably been 90 meetings between subordinates. So I am sure we have been putting pressure on China to put pressure on Iran to come to the negotiating table because clearly this is impacting. Now, China was pretty well prepared for this. They have a huge amount of storage of oil, but eventually this will hit them. So there is an incentive for China all by itself, without us asking, to get Iran to the negotiating table at some point. Now, when that happens, it is maybe a matter of months, not weeks. But there is clearly an incentive for China to ultimately get that Strait of Hormuz opened, as it is for literally the entire rest of the world. In fact, the one country that has the least incentive to open up the Strait of Hormuz is us because we don't depend on the oil. Well, we don't, except California does. California gets 75% of their oil imported from the Strait of Hormuz or goes through the Strait of Hormuz. But that's because they have ridiculous energy policies. But the reality is, we have the least amount of incentive to reopen the strait, and China has way more incentive. So, yeah, I'm sure they're asking about it, and I'm sure that's ultimately how this is going to get solved. Could the market pull back on that news? I don't think the market is really trading on that, you know, particular data point or an issue. I think ultimately the market believes that this is by one way or the other, this is going to get solved and it's going to get reopened. So that's how I'd sort of answer that question.
Great. You made reference in your presentation to the Korean economy, and I know we are now, at least in the moderate portfolio, we bought into South Korea. Can you just explain what the portfolio management team likes about South Korea?
Yeah, we like Samsung and SK Hynix a lot. Those are two memory chip makers. They're just like Micron. They have skyrocketing demand for their products. We also like, just generally speaking, the direction that the Korean economy is going. And there's a lot of other favorable things that are going on in terms of shipbuilding and whatnot. The trade agreement with them is, I think the details are still really getting hammered out, but I think that'll be a positive. But ultimately, we want more exposure to chips, to memory chips.
Yeah. Okay, great.
But it's a good point. I mean, like, if this strait does not get opened up, like let's just say in the next couple months, we will have to revisit that position because, Korea is a big importer of Middle Eastern oil. And so that's going to be that could become an issue for them economically. But so that's a good point for people to keep in mind. But for now, we love that economy, and we love those two companies.
Great. Good. Well, as always, we will be following up after the presentation and webinar recording are approved through compliance. We'll be sending them out to everybody on the call. If you have questions as a follow-up, please reach out to Jim or me or anybody else on the Lear team. We appreciate you tuning in today. Hope everybody has a great Memorial Day weekend, start to the summer, and we'll see you at the beginning of June. Thanks for joining us.
All right, take care, everybody.